Welcome to Bloomberg ETF IQ Europe. I'm Francine Lacqua. Now, over the next 30 minutes, will be your guide to the region's €1 trillion market in exchange-traded funds. Everything you need to know about the funds and the flows. Back in the game, competition heats up as Credit Suisse Asset Management re-enters the European ETF market 7 years after its exit. Buoyant bonds as investors weigh the risks from coronavirus. More than €3 billion has flowed into fixed income ETFs in Europe so far this month. Plus, does the rise of passive exchange-traded funds zombify markets? We'll debate that later. But first, let's get straight to our top story, the heating up of competition in Europe's ETF market. Well, 7 years after it exited the market, Credit Suisse Asset Management has announced it's getting back in the game. The Swiss firm is converting 3 of its index funds into ETFs, which will trade on the Deutsche Börse, SIX Swiss Exchange, and the Borsa Italiana. Now, back in 2013, the company quit the business, selling its products to BlackRock. Let's get more now with Athanasios Porafagos. He is ETF analyst for Bloomberg Intelligence, and also joining us for the whole show, Whaley, BlackRock's EMEA head of investment strategy for iShares. So welcome both to the program. Athanasios, what prompted this, and actually, what does that mean for the market as a whole?
Yeah, so if you actually look at the strategies they brought, right, they brought up MSCI USA, 2 ESG ETFs. It seems like a lot of it was client-driven, right? They were offering mutual funds. They said clients likely push them to launch ETFs. They said, okay, our clients are demanding this, let's launch some ETFs. This is not uncommon. We've actually seen this in the US too. Northern Trust had an ETF business, they closed it, they came back in with funding ETFs with their own client assets. So luckily this is coming from the client side as opposed to them wanting to re-enter the business. Okay, so that means, but if you look at the strategies, and I want to get Whaley here in just a second, if you look at the strategies, what does it tell us where they can actually, where they think they can make an impact? Yeah, so I mean, if you look at the strategies, they're pretty plain vanilla core, right? So they have 2 ESG ones and 1 MSCI. So likely a lot of these products, they exist already in the marketplace, right? So it's just their clients, they were using mutual funds saying now they prefer the ETF, whether they want the intraday liquidity or whatnot. So then now they're offering the same strategy in a different wrapper, and that's really the essence of this move. So competition's heating up. Is that a good thing because it means the market is growing, or can they actually, eat each other? I mean, competition ultimately I think is a good thing, but as long as it's healthy. So if you look at last year, you had BMO exit, you had new firms come in. So I think competition is always ultimately healthy for the industry, but what I'd like to see is firms that stay committed to the business, right? So the BMO one was interesting because when you don't want to see firms that aren't committed to the business, because that then provides an issue for an investor, right? They have to go find new products, there'd be tax issues with that. Whaley, you're committed to the business. How do you see the business changing?
Absolutely. To your point about competition heating up, I think that is a great thing for the ETF market. If you think about the penetration of ETF versus the underlying market, for equities globally, we're talking about 4%. For fixed income, we're talking about 1%. It's really, really low. The pie is growing, and we want to grow the pie. If you think about the European ETF business, it has doubled over the course of last 5 years. It's growing really, really fast. There are structural drivers for this, some of them regulatory in nature, some of them liquidity growing, and the whole ecosystem improving in nature. It's very exciting to be part of this game. But so it's doubling, but it's still so small compared to the US and Europe. What needs to happen in Europe for that really to grow to a sizable amount? Well, I think right now what has been happening, if you think about regulation, MiFID, wealth industry going from a retrocession driven to fee-based advisory, all of that have really led to greater adoption of ETF. And if you think about globally within the investor portfolio construction space, there is a lot more focus on portfolio holistic rather than products in particular. And this holistic approach to portfolio is going to really drive model portfolio adoption, and all of that will lead to a greater adoption of ETFs. So definitely a lot of catalysts there, and I wouldn't necessarily say that Europe will exactly follow the path of the US market, because the market is more fragmented, more markets, more currencies, and drivers of European ETF markets may well also differ a bit from that of the US. So plotting our own path.
Yeah, because it's structurally very different. So what happens, and I know I've had a crash course, more than one, with Athanasios, and you were trying to explain to me that actually, the pie is so much smaller here, it'll get bigger, but can we ever really rival the US market? Probably not.
I mean, probably not. There's so many big differences, right? Not only is there operationally fragmented, but it's also culturally fragmented too, right? So I think that sort of goes underestimated a lot of times when you're trying to sell across different countries. The other thing is when you think about the U.S., what the big driver was tax efficiency of the U.S., right? That, a lot of times, depending on where you're looking, where you're domiciled, that sometimes goes away. So sometimes that catalyst, which has been so strong in the U.S., doesn't necessarily provide the same tailwind here in Europe.
But I would add to that in that usage range, the European range is going global. So if you think about some of the tax advantages for Latin American investors, for APAC investors, they are increasingly looking to the usage range in addition to the US range for their global portfolio construction. So definitely there is a parallel movement happening.
Do people ask you for active ETFs? Does it make a difference? I mean, is there going to be bigger demand for thematic ones, basically?
The answer is yes and yes. So what we have increasingly seen investors doing is to actually be more active with their passive or indexing building blocks. So they recognize that you can either embed an active strategy within the wrapper, and there are more conversations around that, especially in the US, or you can be very active with the very reliable granular building blocks, which is what investors do a lot here in Europe, being very tactical and active with ETF building blocks. And thematics, you mentioned, is definitely a big driver, together with fixed income, together with ESG.
Great. Thank you both. Athanasios Psarophagis there from Bloomberg Intelligence, Wei Li from BlackRock. Stay with us. Now let's also take a look at what's hot in the world of ETFs this week. Which countries and sectors have been attracting the money? Well, Danny Berger has been looking at the numbers. Hi, Danny.
Hi, Francine. I'm looking at FFLO. So these are globally listed ETFs specifically tracking European countries. And as a whole, we saw net outflows this week of 121 million. But diving into the actual countries themselves, the biggest outflow comes from Germany, $229 million, leaving the region, something we've seen for most of the year. But in a change, the UK has gotten a lot of inflows this year. But over the past week, ETFs tracking the region actually saw outflows. There's a lot of drama over the cabinet reshuffle from Boris Johnson, but just generally, there's a sense in Europe of worsening data heading into 2020 that likely won't get any better with the effect to the supply chain from coronavirus. Now, one of the ones I want to point out is the leader we saw in terms of the country getting the most flows this week. That's Italy, $121 million flowing into ETFs tracking the region. Both equity and bond ETFs got some attention this week. Perhaps there's a sense of diminishing political risk, but there are just so many events on the horizon when it comes to Italy and politics that this might be more of a tactical trade rather than any sort of long-term play on Italian funds. Francine?
Danny, thank you so much. Danny Berger there with some great maps and charts. Let's get more with Athanasios Psarophagis from Bloomberg Intelligence and Wei Li from BlackRock. Wei Li, when you look at some of these maps, funds and flows, how difficult are they to actually see before? For example, what happened in Italy this week that we didn't see 2 weeks ago?
Well, when it comes to ETF flows, we have to recognize that we have to sometimes look beyond the day-to-day fluctuation and focus on the themes. So yes, this week we saw inflows into Italy, outflows from Europe, but the broader trend when it comes to European equities has been the trend of actually persistent outflows. So going further back 12 months, including since beginning of last year, European equities actually saw, up to $100 billion of outflows from ETF, but also from active exposures. And that, when you viewed in conjunction with the fact that the market has actually done very well, you see this dislocation and you wonder if that presents opportunity.
Yeah, and is that how you track it too?
Yeah, I think I agree. Day-to-day flow can sometimes be very noisy. There could be sort of one-off trades, one-off allocations that are happening. But we always like to look at the broader trend and sort of maybe at a moving average of flows and to really get a big picture. But like you had said, the flows out of equity ETFs in Europe has just been pretty predominant for quite a while.
Is there, a general theme when you look at, what we saw on Friday, for example, in Germany, the economy not great. Does that impact the world of ETFs in Germany, or is it, largely unrelated?
Well, a lot of clients do look at ETFs for tactical allocation, which is why you saw the outflow almost simultaneously, but also a large and increasing percentage of ETF users start to embrace ETFs as part of their core holding. And those clients, they don't move in response to daily headlines. They will consider if this growth blip is structural in nature, and that may come through in flows in 3 months' time. So the combination of structural and tactical usage means that there's a lot of exciting things that we can talk about within ETF space.
All right, and more of that is coming up next. Athanasios Psarophagis, ETF analyst for Bloomberg Intelligence. Wei Li from BlackRock stays with us. Coming up, fancy taking a bet on Europe's growing population of pensioners? Well, believe it or not, there's an ETF for that. More on that next. This is Bloomberg. This is Bloomberg ETF IQ Europe, everything you need to know about the funds and the flows. I'm Francine Lacqua. Now, there are now ETFs for just about everything. Every week, we dig down into some of the exchange-traded funds you may not have heard of. Well, here's Danny Berger with this week's There's an ETF for That. Danny.
Francine, the world's population is getting older, but luckily there's an ETF for that. The iShares Aging Population ETF is a thematic fund. It's cross-listed in London, Italy, and Switzerland. Its ticker aptly named AGED for aged, of course. Now, its goal is to invest in companies that will benefit from a global population that's expected to live for longer. About 41% of the assets in it are healthcare companies, so we see things like the medication firm in the U.S., OPCO, and an equal amount are invested in financial firms, so you get services like retirement planning and insurance. It also holds some recreational stocks like hotels and cruise liners. Now, total AUM comes in at about $320 million. It launched in 2016, but since then, it has been underperforming the global benchmark. Over the past 12 months, it's gained just about 12% compared to a nearly 20% gain for global equities. So maybe this ETF just needs to age a bit more before returns pick up. Francine.
Danny, thanks so much. Our Danny Berger there. Now let's discuss the rise of thematic exchange-traded funds in the U.S. You can buy an ETF to invest in robotics, solar, polar, or clean energy. Now there's a new startup in Europe called Rise, which describes itself as the region's first specialist thematic ETF issuer. Let's discuss all of this with Wei Li, BlackRock's EMEA head of investment strategy for iShares. Wei, is there going to be a lot more appetite for these kind of things? And are we going to see the emergence of this, or is it risky? Because it's basically like an active ETF fund, but it could, is it not more simple just to have something that tracks a company instead of these kind of themes?
We definitely have been seeing demand for thematic-based ETFs just because the story is very easy to get, right? And the beauty of thematic investing is also that it doesn't necessarily respond to the ebbs and the flows of the cycle, of the monetary cycle, of the economic cycle. So maybe in 1 year it could underperform, in another year it could outperform. It could potentially bring diversification in the long term because those themes does take a long time to play out. So investors want to have various arsenals in their toolkit, and thematic ETF is definitely one of them.
Okay, where do you see the hottest ETFs coming from? I mean, if you look at themes, is it, do you have something with viruses? How do you pick the ones that people want to buy?
Well, given the year-to-date event in coronavirus,
yeah.
It's foreseeable that maybe some players would want to kind of think about what that means in terms of a longer theme. But when it comes to ETF construction and due diligence, we do want to take time to make sure that we're not just following the next fad. We want to make sure that there is adequate liquidity to support flows that could be coming in. There is rigorous construction of the index itself, so we don't just chase the next headline.
So how long does it actually take to build one of these? So let's say today you say, I want to do a thematic ETF on, I don't know, like cups or something like that. When does it, how long is the process for them to be able to sell it?
Well, there isn't a standard, like a period of time from beginning to finish. It obviously varies from exposure. It obviously varies from the wrapper and the listing and all of that. But to my earlier point about wanting to be really prudent in terms of constructing the best product for our client, we want to make sure every step of the due diligence process is properly exercised. analyzed and looked into before we take it to our clients and gauge interest and book build.
Do you think there's more thematic interest from US clients than European clients, or does it not really make a difference?
I would say that there has been more thematic interest from the wealth clients, and that cuts across to both US and EMEA, in that when you position a thematic exposure, the narrative really resonates strongly with this particular segment.
Thank you so much. Wei Li from BlackRock stays with us. Now, coming up is the rise and rise of passive exchange-traded funds, zombifying markets. We'll debate that next. This is Bloomberg. This is Bloomberg ETF IQ Europe. Everything you need to know about the funds and the flows. I'm Francine Lacqua. Now let's take a quick look at the ETFs, which are attracting the money this week. With your European leaderboard is our Danny Berger. Hi, Danny.
Hi, Francine. Well, topping the leaderboard this week is an iShares ETF that tracks European core bonds. It got nearly $1 billion of inflows to start the week, and across the board for all bond funds, this is actually a record week of inflows, so a sense that investors are moving into those haven assets as the coronavirus impact threatens supply chains. Now, what I really want to concentrate is that third one there, the S&P 500 ETF from Invesco. This one is interesting because it's a synthetic ETF, which means it doesn't hold the actual physical shares of the S&P 500. Instead, it uses derivatives and swaps and essentially mimics the performance. And there's a clear structural shift that investors have put their money into this one and withdrawn it from a physical one. So when we look at the biggest outflows of the week, you'll see a nearly identical amount of outflows as that one had inflows to an iShares S&P 500 ETF. Now, this one is the second one there, 274 million pulled from it. Again, this one tracks the physical actual shares of the S&P 500. So in Europe, these synthetic ETFs are much more popular than they are in the US, and investors might be shifting their money because there's not the trade friction associated with having to buy and sell those individual shares, some tax benefits there, and in this case, that Invesco one is simply cheaper. Francine?
Thank you so much, our Danny Berger there. Well, let's get more with Wei Li, BlackRock's EMEA Head of Investment Strategy for iShares. Wei, where do you see this going, actually? I mean, does it change? Is there a lot more appetite for ESG, and how flippant is this appetite?
Well, last year was a bit of a game change and sea change for ESG investing because we went from investors perceiving ESG to be just a feel-good factor to actually seeing concrete evidence that it could lead to good performance. For example, in emerging market investing, the G component of ESG actually have been proven to lead to better performance over a long period of time. So because of this concrete tie-up with facts, with performance, we see investor appetite for ESG increasing significantly. And Europe, in this case, has actually been leading the charge for adoption for ESG and sustainable investing. And within that, you see Netherlands, you see Nordics really pushing the boundary there. And so far, most of the appetite, a lot of the appetite we have seen come from institutional client segment, but it's increasingly also resonating strongly with wealth and retail, thinking about the generational shift and the focus. And we definitely see this being here to stay, and consideration for ESG and climate will be the core part of investment strategy consideration going forward. So,
Wei Li, how difficult is it to know how big that market will become? So, ESG ETFs?
Well, right now, ESG ETF is about 66 billion. Last year, we saw 22 billion of inflow. So you can see, even though it is still quite small within the ETF space, less than 1% of the AUM is growing at really significant rate. We believe the whole pie, ESG sustainable investing, including ETF, but going beyond, could go beyond to 1 trillion and beyond. So that's the sort of ambition and belief that we have in this space.
And do you see, if you break it down, is it, do German investors, are they more acutely aware of this and more likely to invest in that than Italian or French, or is it, can you break it down by country or not?
We used to be able to break it down by country in that I talked about the Nordics and I talked about the Netherlands being really thoughtful about this. But increasingly, we're hearing it from everyone that they want to be more ESG aware and incorporate that into their portfolio process. And we offer a range of choices when it comes to ESG, because there is the screening, which is by exclusion, and then you have the optimized, enhanced, which is around kind of optimizing ESG score whilst keeping a close tracking. But then there is also best practice ESG leaders, and we see increasing interest for this stricter and more on board way of investing in ESG. So definitely the tide has turned and it's happening very fast.
Oh, wait, thank you so much. Now let's get passive aggressive. Bad news on the global economy keeps coming, but stocks keep rising. Last week saw the S&P shrug off the news and fly to its best week in 8 months. Now, Michael O'Rourke from Jones Trading blames the rise of passive ETFs zombifying markets. He says they don't care if they buy at 10 times earnings, 20 times earnings, or even 50 times earnings. Let's get back to Whaley to, I guess, shed light on some of that criticism. Any truth in this?
It's a very catchy segment title, passive aggressive. I love it. Well, I wish ETFs are big enough to zombify the market, but as I talked about earlier on, our penetration of the underlying market is 4% in equities and 1% in fixed income, which is really nothing in comparison with kind of the runway that it presents. But what we do see ETF doing, instead of zombifying the market, is actually rejuvenating the market in the form of price discovery. So if you think about, use the case of Chinese ETFs trading in foreign exchanges whilst the underlying market is closed, we actually see investors being really grateful to be able to express their investment views on the underlying market when they couldn't via when they couldn't in the underlying market, they can do it in ETFs.
But wait, very quickly, if the market gets bigger, as you said, is that a risk afterwards that, without zombifying, that you're miscalculating risk?
Well, I would also say one thing, which is that as the market gets bigger, it's becoming more, it offers a lot more. So if you think about right now where we are, there are 70 times more indices than there are stocks in the world. So we see investors being very granular, active with ETFs, and we don't see them moving in only one direction.
Whaley, thank you so much. She's from BlackRock, and this is Bloomberg ETF IQ.